Hey folks, and welcome back to another video on my YouTube channel. So I realized I have not made a video, um, you know, directly on liquidity. So that is going to be today's video. And that's because liquidity is fundamental to understand ICT. That's the base of ICT himself. All his concepts are based around liquidity. So of course, I'm going to have to do a video on liquidity. And basically all liquidity is it is buy stops and sell stops. So in reality, all it is stop losses, right? And the reason that liquidity is important is because the market runs on an algorithm, okay? And that algorithm is programmed to seek different things inside the market, okay? And when ICT talks about what the market specifically seeks, he always mentions two things, okay? And that's liquidity and inefficiencies. Okay. But how do you find liquidity on your chart, you might ask? Or how do you know what liquidity to consider valid and what to ignore? All of that you will learn in this video, hopefully. So firstly, let's establish what it is, how it looks, and how we could find it. So if you look at my screen right now, you would have a perfect example of sell side liquidity. We have a swing low being made here because it is a low that is lower than both of the candles right next to it, right? And the reason we would call this sell side liquidity and not this low is because we have to think about liquidity as stop losses, okay? Where are they placed? If a person went long right here, where are they most likely going to place their stop? Where are they taught to place their stop? Below the low, right? So that is why we would consider this sell side liquidity, because all the people that went long right here placed their stop below this low, engineering liquidity for us SMC traders, right? And in the opposite scenario, we have buy side liquidity, right? You find the swing high, and it is a swing high because it is higher than the both candles next to it. And all the people that went short up here placed their stop above the swing high, right? Because that's what they're taught, right? That throughout their whole trading career, that's what they've been told: place your stop above the swing high, right? So they're not going to place it at this high. They're not going to place it here. They're going to place it here. So that is why we consider this liquidity, specifically buy side liquidity, right? And we also have something called equal lows and equal highs. And all that basically is, it says it in the name, it is lows that are equal or close to each other, right? Because then the algorithm has engineered more liquidity, right? All the people that went long here placed their stop at this low. People that went long here placed it here. People that went long over here placed it here. So a lot of stop losses are waiting to be accumulated down here. So that makes this even more significant, right? Because there are way more stop losses here than on the previous slide, right? And I hope that makes sense. So equal highs and lows are always very valid points of liquidity, and the higher time frame, the better, because the higher time frame, the more time people have had to put their stops below or above the higher low, right? Then we have session highs and lows, and that is very simple, even though it may sound confusing to new people. So in this scenario, I have decided to give you an example of the London session, which is from 2 a.m. to 11 a.m. EST. So what you would do is draw out 2 a.m., which is this red line. That's what that represents. That's 2 a.m. Then the other red line, which represents 11 a.m. And everything in between is the London session, right? Then you would mark out the highest point of the London session as London high and the lowest point of London session as London low. So all the stop losses that were placed in London session have a very high probability of being placed either above here or down here. That is where most stop losses are placed. So these session highs and lows are always very valid liquidity points. And if you're confused on how to use liquidity, you would have to find a model that's where your model comes into play. Typically what SMC traders do is they wait for a liquidity sweep, and then their model appears somewhere over here, right? So you wait for a liquidity sweep, then maybe you enter off of a fair value gap that forms after the liquidity sweep to the downside, right? Where a lot of retail traders may think that, okay, we broke this high, now we're going higher, right? So you're basically doing the opposite of all the retail traders, right? And you also just took out all the stop losses of people that went short over here. So that is basically the session highs and lows and why they're important. Then we have resistance liquidity, or low resistance liquidity, as some people call it, which is basically, if you look at this from a retail point of view, this could be a bull or bear flag, I think a bull flag in this scenario, right? So a lot of retail traders would place their stop above here, and above here, right? Because these 3 points are all points where price retested some sort of resistance level, right? Or trend line level or whatever, right? So you have to kind of adapt the mind of a retail trader and think, where would they place their stop? In this case, it is kind of obvious where they would place their stop. It is at this resistance level. Down here, you would have a support level, which could also be valid liquidity, right? All the people that went long off of this bounce here, they got stopped out right here, right? So that is always very valid liquidity points. Had price came up here, then maybe stopped out all the trend line traders here and then went back down, right? Because that's all the algorithm seeks. Stop out traders and then go in the other direction. How many times have you tried as a retail trader? Because I believe that most of us started out learning retail. How many times have you tried where the price hit your stop loss and then returns in your favor directly after, right? That's because you were liquidity, right? Price accumulated your stop and SMC traders entered in the opposite direction, right? So that is resistance liquidity. Then we have daily highs and lows. This is very, very simple to mark out. This is taken on a daily chart. And if I want to find yesterday's high and yesterday's low, I could just go on the daily chart and mark out the high of the previous day's candle and mark out the low of the previous day's candle, right? But this high right here and this high right here and this low right here and this low right here are all very valid liquidity points, right? Because that's the highest point of the day, lowest point of the day. So this is where most stop losses are placed. So this is always very valid points of liquidity, okay? Then we have old highs and old lows, right? This is the hourly chart. So these lows right here are fairly old, right? And they're also, in this case, equal lows, right? But just ignore the equal lows. Old highs and lows are always also valid liquidity points. So this is probably a few days old worth of liquidity. So a lot of stops are sitting below these lows right here. This low too, right? Maybe these equal lows over here as well. Remember, this is on the hourly chart. Had this been a 1 minute chart, this would not be old highs or old lows. And there's no really rule to how old or whatever a high or low has to be. But remember, equal lows are always better, right? So if you were bearish, let's say I was bearish for the week or whatever, maybe my target was these equal lows because they're equal and they are old, right? So that is also very, very valid liquidity. Of course, you can trade liquidity that I did not mention here. This is just what ICT has mentioned as valid liquidity and what he looks at. I'm sure he uses a 1 minute liquidity too. That all depends on your bias and your screen time. But you would never go wrong with liquidity that I mentioned in this video. That is basically why I mentioned it, because this is safe liquidity to use, right? Always valid. There's no confusion around this. That's why I decided to include only this in this video, right? Of course, this is liquidity. This is liquidity. This low right here is liquidity. This high is liquidity. This is liquidity. This is, every swing high, swing low is liquidity, right? And then it just comes down to screen time, bias, whatever, delivery, all these different things to find out whether you would want to use that liquidity as valid, right? But the the liquidity that I mentioned in this video is generally always going to be valid liquidity. Okay. So I hope you enjoyed, and if you have any questions regarding any of ICT's concepts, just ask me in the comment section below. I try to answer every comment to the best of my knowledge to help you guys out. So don't be afraid to ask me in the comment section below. And until I see you next time, stay blessed and bye-bye.